Context is everything. And the markets are abuzz right now with the US jobs data. 256,000 jobs were added in the US in December, and this is good news. It's pushed down unemployment in the US to 4.1% from a previous month's data of 4.3%. Now, this is strong data, there's no questions about that, and it's not just numbers. There's very real implications wherever you are, whether you're running a business in the US or in Europe, it matters. And it primarily matters because we're unlikely to see rate cuts in the US between now and at least the next FOMC meeting in March. So what does this mean? Well, it means borrowing in the US is going to continue to be expensive. If you're a household, that means your mortgage costs. It means your credit card costs. And if you're a business, it's about your ability to invest in new markets. It's your ability to finance growth. And in some businesses, it's going to affect your ability to access cheap cash flows. But let's zoom out a little bit. The market is disinflationary. This is good news. Prices are stabilizing, and the labor market is showing necessary adjustments and shifts. The US unemployment rates are down, but they're still higher than the 3.4% that they were ahead of the current cycle. In Sweden, we're seeing unemployment remain at about 8%, Norway about 4%, and in Denmark around 3%. So we're seeing mixed data from around the world, but we are unlikely to see rate cuts in the next couple of months in the US. But in the Eurozone, we are likely to see more rate cuts in the coming months. But the key takeaway, wherever you are, whether you're in London, Oslo, Copenhagen, or New York, it matters. We saw investors panic on Friday. The stock market right now is volatility city. And the ripple effects occur around the world. When the US stock market sneezes, we feel the cold in Europe. But there's opportunities. There's opportunities for European businesses that are exporting to the US if it's priced right. The questions you need to be asking yourself today are you able to wear the cost of increased borrowing in the US? And if you don't know, then you're already behind the game. But you also need to be asking yourself about what your existing exposure to US markets is and what this means for you. But also, if you don't yet have exposure to US markets, is this something that you should be exploring in 2025? And lastly, considering your runway. What are your current investments, your current capital flows, and what should you be adjusting based on this recent data? But keep in mind, it's a long game. What can you be doing to position your business with these risks and these opportunities in 2025 and beyond? Speak to the experts, make adjustments to your plan, and execute successfully.